Welcome to JXG Spotlight, where we dive into expertise across our group with an exciting line of personalities. I'm your host, Gamika De Silva. Today, we are going to talk about beyond savings. We've been taught about savings from our childhood, and we have many examples, many iterations about saving. But what is it beyond savings? How do we grow our wealth? How do we look at investment? So this is the topic today, and no other better personality than my guest today to explain about all about investment and going beyond savings. My guest today wears multiple hats. He's the managing director, CEO of First Capital Holdings. He's also the deputy CEO of Janashakthi Group, and he is also the chairman of Colombo Stock Exchange. So let me introduce Mr. Dilshan Wirasekara. Dilshan, you're the spotlight today.
Thank you, Gamika, and thank you for having me here.
Dilshan, diving into this topic, first of all, I would like to know about your journey on investment banking. You're heading a company which is 4 decades old in terms of investment banking and a pioneer in Sri Lanka. How did you get into this role?
Quite by chance, to be frank, Gamika. So I started my career off like a bank. As a bank, I think we both wore those same hats for a long time. Went through the ropes of traditional branch banking and was lucky enough to land myself fairly early in my career in the treasury or the dealing room, which sort of specializes in capital market investments and foreign exchange. Was there for a good 15 years through Pan Asia Bank, Nations Trust Bank, ended up heading Nations Trust Bank Treasury. However, in 2009, I thought I'll venture out and start my own investment firm, and that's how I got into investment banking. To be frank, that didn't go too well. Our markets didn't perform well during that period. And I then ended up sort of moving from banking to investment banking and joining First Capital about 11 or 12 years ago. So quite by chance, but I think one thing was my passion to look beyond banking, beyond savings, and to see how we create wealth for Sri Lankans. I would say was the driving factor that was the reason for me joining First Capital and trying to see how we can spread investment banking and its products across the nation than the traditional mindset of banking, FDs and savings.
Interesting journey indeed. Dilshan, to start the conversation on, not too long ago, I mean, if you look back at the last 2 years, we went through a complete turmoil of economy and our inflation rates were going up. Amidst a situation like that, as an expert, how do you advise our audience about saving and managing wealth?
Sure. So I think there's a misconception of people looking at interest rates and believing that that is the return that you get on your investment or savings. So I want to make this distinction between nominal interest rates and real interest rates, right? Or nominal rate of return and real rate of return. And I think the difference is taking inflation into account. So nominal interest rate is the gross interest rate, the simple interest rate you will get paid. So we'll say if you have a 1-year FD and you're paid 10%, that is your nominal rate of return.
Right.
Now, then you need to look at inflation, and we'll say inflation is 8%. We'll just assume it's 8%. You deduct inflation and your real rate of return is then 2%, right? So your money is only growing, or your purchasing power is only growing by 2%. It's not growing by the nominal interest rate.
Right.
So I think that is something that a lot of Sri Lankans don't understand, don't know, don't focus on, right? So that I think is the first point to sort of take note of. If you look at the economic crisis that unfolded in 2022, we had inflation touching 70% at its peak, right? I think the average inflation for that year would have been over 50%.
Right.
Now, what that means is that if you had not invested or you didn't get a nominal interest rate above that inflation rate, that your money actually lost its worth, your purchasing power declined. And sadly, for a lot of Sri Lankans, that was the fact, because there wasn't a investment opportunity out there that would yield you above 50%.
Correct.
right?
Yeah.
Not in terms of the conventional norms. But there were certain asset classes that held ground, right? So I think if you look at 2022, it's quite unique. It's a one-off. I don't think, and I certainly hope and pray that we never see that happen again.
Surely.
But essentially what happened was that we faced the economic crisis, we ran out of foreign currency, and then obviously the central bank had to depreciate the currency in one go. Overnight, you had an exchange rate of 200 that went to 360 in a matter of a day, right? So you had a correction of about a 70% on the currency that would have translated to any imported goods being more expensive by that margin. Right. So, we are an import dependent country. There is, imports outweigh our exports. So most goods and services got repriced based on that. And obviously then you have essential items like fuel or utilities that also are priced off international markets. We did those changes in 2022. So fuel prices, electricity, everything virtually sort of doubled.
Right.
Again, I'm using the context of double to make the explanation easy and simple. So if you had, prices of goods and services doubling, and your amount of money at a given point, and this happened sort of overnight, I think Sri Lankans essentially their wealth halved in a day. So even for you and I, if you had money in the bank or invested wherever, the purchasing power of your money sort of lost ground by approximately 50%. So how do you recoup that, right? So that's really what I think investing is about. Forecasting that, looking at that, and choosing assets that will outperform inflation and therefore then grow your wealth. One example, I think, in that shock was gold. So had you chosen to invest in gold, and we know we don't produce gold is imported, gold is pegged to the US dollar, had your wealth been stored in inflation, you wouldn't have lost a single cent. Right, because it's locked in. The price of gold also kept pace with the dollar, kept pace with inflation, and your wealth would have essentially been the same. Now, not all Sri Lankans have the ability to store their wealth in gold, and obviously it's not practical to have all your wealth in one asset class, but choosing asset classes that outperform inflation is really the key or the trick here.
So I will come into the asset classes later on in our discussion. One of the factors, Dilshan, I also thought about, whilst our literacy rate is around 90%, our financial literacy is somewhere around 57% as per the records in 2021.
Yes.
Given this scenario, when somebody starts their investment journey, how do you build the basic building blocks? How do you start? I mean, your advice to a beginner.
Yeah. So first of all, I think building that knowledge is important. You can't be ignorant of investment options, markets, and then look at investing. So I think first thing is, having that financial literacy, having a basic knowledge of what's out there, right? In Sri Lanka, broadly, I think you have 3 asset classes that masses can choose from. You have fixed income securities, so interest-bearing investments that pay you a fixed rate of return. You have a choice from bank FDs to corporate debt to government securities that I think takes care of about 90-95% of fixed income distribution in this country. Then you have equity, that is buying shares of a company.
Right.
And obviously then, based on how well that company does, the share price will reflect that. You learn also dividends out of profits that that company distributes, is the second asset class.
Right.
And then you have real estate, which is the third. Sri Lanka doesn't have a advanced capital market that has commodities or derivatives or the complex futures, options sort of products yet. But so broadly, these 3 asset classes, right? Okay. So I think it's important to have a mix. It's important to diversify and to choose between these 3 asset classes, which we all have access to, in a way that you outperform inflation. So I think that's really the key. So my first point would be have basic knowledge of how these 3 markets operate. Right. I think when it comes to fixed income securities, that's the easiest to understand.
Yeah.
But a lot of people only know the bank deposit or the savings account as a fixed income
Correct.
instrument. If you look at where money is stored in Sri Lanka, Gamika, the fixed income securities have the largest part of wealth storage. It's about 35 trillion rupees of wealth that is stored. And if you look at where that is, you have half of it in government securities, treasury bills and bonds.
Yeah.
That is where you're essentially lending to the government of Sri Lanka. Still considered the safest instrument you can invest in, because the government can essentially keep printing money to pay you back. So they would be, I think, the last entity to default or fall in terms of a crisis.
Right.
So you still consider that investment risk-free in Sri Lanka. Then you have the bank deposits, which can be savings deposits, call deposits, fixed deposits, that give you a fixed sort of rate of return. That market also is about a 16 trillion market. And then you will have some corporate debt instruments like debentures, commercial papers, which I think you don't have official number there, but my estimate is it's probably about 1 trillion rupees or so. So you have a 35 trillion fixed income market. Then if you look at equities, again you have listed equities, you could have unlisted equities. I'm only going to talk about the listed equities, which is companies that are listed on the Colombo Stock Exchange and their shares are trading there. We have a market cap of about 4.7 trillion rupees there. So if you collectively look at all the shares that are listed on the exchange, about 275 companies, you have about a 4.7 trillion of wealth that is sort of stored there. So that's, to me, the biggest component, and I think that's what Sri Lankans are comfortable with. You put X amount of money, you will get this rate, and Y is paid to you at the end of it at maturity. Sri Lankans are quite comfortable, but unfortunately, they are not so aware of the government securities and the corporate debt side of it. They concentrate mostly on the bank deposit side of it, fixed, which is the lower rate spectrum. So you get paid maybe 3-4% on savings accounts, 8% on FDs, whereas the government securities market is paid between 10 to 12%. Based on the tenor. Now, it's strange that the government security, which is a better risk class or lower risk category, is actually offering a premium over the banks. Right? And the strange thing, and I think it's more because of the public's ignorance of knowing the risk categorization, what's happening is they say with the banks, and it's the banks that go and then buy the government securities. Right? So you have that sort of transmission happening with the bank sitting on a spread of 2% on a risk-free asset
for them,
whereas the public is actually taking a higher risk asset because the bank is lower than government in terms of risk, and making that spread. In a normal functional market where price discovery happens on demand and supply and risk metrics, you would have the opposing. You would actually have the government security rates lower than the bank interest rates. But in Sri Lanka, that's there. So that's actually opportunity for the public. You can actually get a higher rate of return in a better risk categorized asset or lower risk categorized asset and get a 2% higher rate. But a lot of people aren't aware of that and how you get about doing it, because it's somewhat technical. It's not as simple as a bank deposit, but that's the case. Equity, again, if you look at equity markets today, the stock market has touched, I think, all-time high as we speak today. It's up about over 22-23% for the first 11 months. If you annualize that, you're probably close to 25% return. You can't get that on fixed income. So had you invested in equity, potentially you could have made a 25%, which is then obviously outpacing inflation at a far higher rate than what fixed income is. And then of course you come to the last real estate piece of it, which I think Sri Lankans like. I don't have a number there in terms of what that real estate value actually translates to, but in terms of return, I think we've had real estate track at about 5 to 10%
Return.
annualized sort of return.
Okay.
But again, that differs based on the location of,
Yeah.
Colombo might grow at a faster or slower
pace,
pace, or suburbs might be some other rate.
Sure.
But again, asset class, I think a lot of Sri Lankans like to have. All of us
You
want to
own
own
it.
our house,
Yeah.
sort of. And I think it's a great asset that stores wealth. It doesn't diminish.
Yeah.
It may not outpace inflation, but I
it'll
think it actually
appreciate. Yeah.
holds value.
Holds value.
And I would advise investors to have
All three classes.
all three classes in their portfolio so that the risk is sort of diversified and spread. So considering having the know-how, considering the asset classes that you have, distributing your investments so that all eggs are not in one basket,
Yeah.
is the way to start that journey,
Right.
Gamika.
Okay, excellent answer. So I think you mentioned about the ignorance of the market. I think we also have a responsibility on our hand to keep them aware, educate them as well. And also on the equity side of it, I think the stock market is, compared to 2022, this is the highest growth that we have seen in the recent past, right?
Absolutely.
So moving into the next question, I think we have been hearing a lot of news and about scams, etc. So the general public, if you look at it, may consider investment as a risk. I know there's a risk component involved. You explained about it and the fixed return, etc. How do we look at this risk? Will I lose my money? And these are obvious questions a beginner will probably ask. Dilshan, what's your advice there?
Of course. So I think, again, that's why I said financial literacy, understanding the product, understanding the risk is important. You can read up. These are not rocket science by any means.
Right.
I think it's pretty simple for any basic person to sort of, understand and comprehend the product. That is one thing that you can do. The second, I think, is you have enough professional advice that you can follow, that you don't need to really have the know-how.
Right.
So you have investment banks, you have investment advisors, stockbrokers, capital market intermediaries in every aspect. So if you take government securities, one of the larger products that have, like I said, 17 trillion of investments in it. You have 10 primary dealers in this country. You have 20 odd commercial banks that can all advise you in terms of the product. Right. So if you can't understand, you can't comprehend, I think the easiest thing to do is seek professional advice. Go to one of these primary dealers, go to one of these banks who deal in government securities, learn about it, understand the product, get advice in terms of interest rate outlook. Are rates expected to come down, go up, and get suitable advice to invest. Similarly, in terms of equity, you have stockbrokers, you have investment advisors who will guide you through. And my one thing is focus on fundamentals. I think in any investment, you look at doing fundamental research to evaluate risk.
Yeah.
You don't take investment decisions on hearsay.
Right.
You don't take speculative things based on sentiment. Avoid those things. Look at numbers and do it. And for a lot of retail people, I think a lot of people think this is only for a certain segment of society who are wealthy or ultra wealthy. I can't invest a small amount. I need to have millions to be able
invest.
to play this game, which is all false. Right. The truth of the matter is you can invest in the stock market even with 1,000 rupees.
Right.
That's as low as the ticket can sort of come down. And while you may not have all stockbroking firms, investment advisors wanting to onboard you at that small level, because we know the companies will look at the deal ticket size and they would sort of target the larger tickets. You can still choose the unit trust as a vehicle to invest in equity. So unit trust is essentially a pooling of funds through different investors into one sort of vehicle, and a fund manager then managing that on a portfolio basis.
Right.
So your 1,000 rupees goes into a pot with many other investors, collectively maybe a 1 billion rupee fund, that fund manager invests as a collective fund.
So this is what you refer as mutual funds?
Absolutely.
Yeah, okay.
So mutual funds is how it's known in the rest of the world.
Yeah.
We have a term called unit trust.
Okay.
That is essentially the same thing, but it's essentially a collective investment scheme where funds are pooled. you can invest in those even with 1,000 rupees. So if you are a small time investor, you don't know about the market, again, trust a fund manager, go into a unit trust, put your small investment in, and still reap the same rewards and returns that you would even if you invested directly. Right? So that's a simple thing. Real estate is not really my forte, but again, I think there are real estate firms that can advise you in terms of acquisition. And I think if you can spread your investment across these asset classes, you should be able to outperform inflation easily.
Absolutely. So our neighboring country, India, is as an industry, promoting mutual funds. I think probably as a market to grow, there's opportunity as well. Thank you for that advice. So 2 more questions to go, Dilshan. One is, can you probably highlight maybe 2 or 3 common mistakes an investor get into by coming into the investment side of it, from savings to investment?
Sure.
What are the common mistakes, Dilshan?
So I think one is also switching between asset classes. Right? People tend to be quite passive in nature, and in these financial markets, which are quite volatile in nowadays, you need to be on the ball, looking at, and if you don't have the know-how, seeking advice of a professional in terms of switching asset class. So I'll give you an example. We'll say interest rates today are at 12% on a 5-year bond. You have an outlook that rates are going to drop, so it's a good rate. It's better than the bank FD rate, so you go and buy a 5-year bond at 12%.
Right.
Now you have invested in this and you wait, and we'll say 1 year down the line, 2 years down the line, rates fall to 6%, we'll assume.
Okay.
Now you're in the money, you're holding asset at 12, it's dropped, but maybe that drop is now the bottom.
Okay.
Right? And it's expected that in the 3rd year, rates might go back up to 15.
Right.
A common mistake a lot of people make is you're passive, so you just hold on to the 12.
Right.
Right? You don't look at maybe selling it at that 6, encashing your gain, taking it out.
Right. Okay.
Maybe staying now short term because the expectation is rates to go up. And when it goes up, you take a short term hit of investing for 3 months.
Right.
But when it goes back up to 15, you buy your asset again.
Okay.
So I think switching investments, whether it's in the same asset class or moving to other asset classes, is something a lot of people in Sri Lanka don't do.
Right.
But we as investment banks, that's how we make money.
Okay, right.
So you don't sit on your investment. You continuously evaluate your investment. You look at it and you invest.
The right return. Yeah.
The next is, I think, people in Sri Lanka tend to put too much weight on sentiment.
Okay.
So you have this what we refer to as a herd mentality.
Okay.
You see one guy doing something,
and
the rest sort of follows blindly, not really realizing. And you've seen that happen in the stock market when there are certain shares that out of speculation, out of rumors, but no fundamentals that support it, suddenly sort of move up quite significantly. It's very enticing at that point, thinking, oh no, I don't want to miss this run, I want a piece of the action, and you get it. But you've done absolutely no fundamental research,
right?
And there's nothing supporting that, and you probably end up buying that at a significantly overpriced rate, and then market crashes and you essentially lose your money. So I think, again, doing proper analysis is important. And if you don't understand that, that's fine. That's why you should go to a professional. Go to a UT. Don't try to do something that you don't know.
Absolutely.
Right? So those are 2 of the common mistakes that I have really seen people tend to make over and over again, and that's something that you can very, very easily sort of correct by getting the right advice.
Absolutely. Thank you, Dilshan. So my last question is, about 2 months back, just before the presidential election, I mean, there was a lot of wait and see in the market. Even now, we are just 1 day away from the general election coming in. I mean, market sentiments vary, the indicators vary. In your expert view, what is the best time to invest?
So you see, I think again, looking at advice. So when just prior to the elections, there was uncertainty of who would come to power. I think there was a concern that a NPP government, which ultimately we got an NPP president, may not be the best. It was perception, right? There were, again, no facts behind it. And you saw a sell-off that was not really warranted for, not fundamentally sort of backed by any data. It was more panic. Again, I would put it back
The
to that
herd
rumor
mentality, yeah.
mill sort of thing. So, I think sometimes the best time to invest is when the market thinks it's the worst,
Okay.
when it's rock bottom, when
Right.
so essentially in equities, you buy low, you sell high.
higher.
Right? There's a saying, you buy on the rumor, you
Right.
sell on the fact.
Okay, right, okay.
That's how you make money.
Sure.
Now, if you look at some of the seasoned investors like, we'll say, Warren Buffett,
Yeah.
right? If you look at some of his acquisitions, he makes them when markets are at its worst.
Okay.
Right? Because the prices are so discounted.
Right.
Right? And as long as you have some analysis to say that, look, this is a blip, this is a temporary dip, and, fundamental will kick in, sense will kick in, you can really make a lot. Right? So I think one thing First Capital advocated prior to the presidential election was that no matter who wins, the fundamentals of the economy are not going to change because we are in an IMF program, and no matter who wins, there is no leeway to really move from this.
Yeah.
Right? Now, if you look at the political rhetoric on stage, was that we will revoke the IMF, we will change this, we will reduce taxes. Has any one of those things happened today, Gamika? No. Because factually you can't.
You have to stay on course.
Exactly. So what we said was, when we did analysis, look, people will say this and that on the political stage, but practically you can't do this.
Can't do that.
Because we would go back to a economic crisis, a default, and we know what happened there. There was Aragale, people came. The same would happen if you try to do that now.
Yeah.
So we based our recommendations on, look, this is a temporary drop. It doesn't make any sense. This is why you should buy now. Right. And whoever took that advice today stand after just 2 months on a 30%
return.
Simple return.
Okay.
Right? You annualize that's 120%. It's off the charts.
Okay.
Right? So I think that's something that you can't say, there's this is the best time
to invest.
But I think when there are sort of significant corrections in price and sort of where markets panic, there may be sort of undervalued stocks. Those are good opportunities to start buying, and that's something that you can actually get advice from a seasoned investment bank or a market intermediary who can help you with that.
Surely. I must also add, Dilshan, I think back in 2022 also First Capital gave the right advice to the market on investment. I think the first and the only to give the right advice. I think that advice actually benefit later on. So must appreciate the team at First Capital for giving that accurate, factual information and advising the market correctly.
Absolutely. So again, there I think you had once in a lifetime opportunity to lock in 30% for as long as 10 years of an investment. Right?
Yeah.
I mean, it's actually a no-brainer, and it's sad that people don't look at it, because we've never had 30% interest rates because we went into default, and there was speculation the government would write off or put haircuts on the bonds, which we did maths to, and I'll just give you a very simple example. So you had a 10-year bond that yielded 30% on an annualized basis.
Right.
People were saying, no, but what if there is a haircut and I lose my money, right? So we said, yes, that is maybe a possibility, but do the maths. So 30% on a 10-year, and if we assume that there was a haircut, we'll assume the haircut was as large as 30%. So if you put 100, you only get 70 back at maturity. But this is a 10-year instrument, right? So if you take a 30% yield and actually look at what is my now ultimate yield after 10 years, a 30% haircut, even if you get only 70 back of the 100 you put, when you annualize it, brings your yield down only by 3%. So your 30% drops to 27. Now, if I was an investor and someone told, okay, here you invest for 10 years at 30, but now I'm sorry things have gone, you'll only get 27. Do I really care? It's
still a better deal,
It's
right?
a better deal, right? So you need to do that math.
Right,
and that's something that we did and we proved, and I think a lot of clients made a lot of money.
Indeed, it was a fruitful conversation to kickstart our investment journey today. So my learning today with that inspiration Dilshan gave us is understand the facts of the market. study the market better, understand different tools. You don't have to have millions to start your investment journey. You can start today with even the smallest amount of 1,000 rupees. Do not let your hard earned money just lie down in an area that you don't get return. Let your hard earned money work harder for you. So thank you very much, Dilshan, for joining us today and sharing your insight and inspiration. So that's it for today. Stay tuned for JXG Spotlight. This is just the first episode. We'll continue to bring knowledge and inspiration. Until then, stay together, push the boundaries for a brighter future. When we stay together, we are stronger than ever.